Hi everyone, I'm Asif Iqbal, business lecturer at Scholar School System. I'm here with you today regarding the lecture for financial analysis of module BMM4133 Principles of Accounting and Finance. First of all, I will do a recap with you from the last week in which we have discussed about the components of statement of financial position, which includes current assets, non-current assets, current liabilities, non-current liabilities, equity, and limitations of this statement. Today we cover the learning outcome, analyze and interpret financial statements using key financial ratios and comment on what they mean for the company's financial performance. What is financial statement analysis? Financial statement analysis involves examining a company's financial statement to assess its performance and inform economic decisions. And this analysis can be done by the benchmarks within the company or between the companies. When do within the companies, then we just compare the current performance with the last year's or the current performance with the planned performance. And between companies, we are doing with those companies which in the same sector, and between companies with the industry average as well. There's a different ratios. First of all, we'll look on the investor ratios. The investor ratio includes the earning per share, which the ratio is profit after tax for ordinary shareholders divided by number of issued ordinary shares. Then we have the price earning ratio, which is the share price divided by the earning per share. And then we have the next one is the dividend per share ratio, which includes the dividend payable to ordinary shareholders divided by the number of issued ordinary shareholders. Then I will discuss about the dividend covered and also called payout ratio, earning per share of the dividend per share. In this ratio, the number of times the dividend can be paid out of current earnings, and the higher the dividend cover, the safer the dividend. Then the dividend yield is there. That ratio is dividend per share divided by share price into 100, which compares dividend per share with the amount invested by the shareholders. Management performance. Ratios include the return on shareholder equity, and the formula is profit after tax divided by share capital plus reserves. Which shows the performance of company from the shareholders' perspective and essential to use profit after tax and after interest charges. Return on capital employed ratio formula is operating profit before interest and taxes divided by total assets minus current liabilities into 100, which shows the performance of company as a whole, measurement of management efficiency, and it relates to all resources of long-term finance. Operating profit on sales formula is operating profit before interest and taxes divided by sales, which reflects the degree of competitiveness in the market, economic situation, ability to control expenses. Then we have a gross profit margin, gross profit divided by sales into 100, which this ratio is mostly constraint of cost of making goods and profit ready for the sales. Total assets usually equal to sales divided by the total assets, which indicates how well a company has used its productive capacity. Then we have the non-current fixed asset ratio is sales divided by non-current fixed assets. Then we are moving towards now liquidity and working capital ratio. First one is the current ratio, current assets divided by current liabilities, which shows that all the company's short-term assets equity are enough to settle down their short-term liabilities. If this ratio answer is less than 1, then looks closely at the cash flow. And this ratio is very important to which shows the ability to generate daily cash might make this ratio adequate. And this ratio must be more than 1 into 1. The next one is the acid test or quick ratio, in which current assets from current assets we minus the closing inventory and divided by the current liabilities. Next ratio is the inventory stock holding period. The formula is inventory divided by average inventory divided by cost of sale into 365 days. And it ratio shows that how quickly the business move through the inventory. The shorter this is better, but too short means the business is out of stock. Customer trade, that is collection period, is trade receivable divided by credit sales into 365, that how quickly the business recover their money from its credit customers. Trade payable payment period, supplies payment period includes the trade payable divided by credit purchase into 365, that how much time the business will take to pay money to, to the suppliers. If paying too fast, it means it's a risk of short cash shortage. If paying too slowly, it means risk of losing the suppliers. Then we have gearing ratios that includes long-term loans divided by ordinary share capital plus reserve into 100. Then we have the interest cover ratio. The formula is operating profit divided by the interest charge, which indicates that how safe the annual interest payment in relation to the profit. Then we have the different steps, 5 steps of financial statement analysis. First step, we will establish our objectives, that who, why we are interested in the business and what information is vital to make the decision. Then the step 2 is regarding to study the industry in which the business operates and the relate industry climate to current and projected economic developments. Then we develop the knowledge of the business and the quality of the management. Then we will do the ratio analysis, which includes profitability, liquidity, working capital, gearing, investment, and segmental analysis if required. Then after that, we will do interpret these ratios and we evaluate the results and draw the conclusion. There's some limitations that one, the limitation saying that the accounting reports contain estimates involving subjective and there is discretion in how accounting rules are applied. Accounting ratios are backwards looking, showing historical cost. The ratio should be interpreted along with economic industry conditions. Companies or analysts may use different definitions. Figures from statement of financial position may not be representative. Ratio shows symptoms, not cause, and do not give answer or solutions. So these are the references from where all the information is provided to you in the previous slides. So thank you very much, everyone. And if you have any question, my email address is provided in the module handbook and other lectures. Emails also provided over there. Then you can ask the questions. Thank you very much for this.